Well, good afternoon, everyone, and welcome to today's Learn at Lunch webinar. We will hear from Extension Specialist Roger Saws as he discusses current Oklahoma land values. If you have any questions for Roger, please ask them through the chat window. And you may open the chat window by clicking the chat button at the bottom of the screen. Roger will answer any of your questions at the end of the webinar. And you may find more information on this and other topics at the eFarm management page. And I will share this link through the chat window. And I will also share a link to the Oklahoma land values page in the chat window. Rogers, I will turn it over to you.
Okay, thanks a lot, Brent, and I appreciate the opportunity to visit with the audience this afternoon in regards to land values. And I hope everyone's summer has gone pretty well, and that if you haven't seen rain lately, that you will certainly in the near future. It's been a long and hot, dry summer. So what I plan to do is to explore some of the trends and patterns in the land markets here in Oklahoma. And we'll talk about what's going on in the overall farm economy and how that translates into the ability to pay for farm ground. You know, I'm a sincere believer that good market information and analysis is really critical if you're an active participant in the land markets. Or if you're just a interested party, or if you're a land holder that either lives in the state or could be an absentee landlord that lives out of state, and you're wondering how's my land portfolio and my overall balance sheet, how is it performing, how is it impacting my balance sheet? Because of course land holdings is a major component of that asset value in the balance sheet. So how it performs either up and down really impacts the health and financial well-being of your overall liquidity and obviously solvency. So let's get started. We've got a lot of real estate, of course, to cover. So I'll proceed on with the next slide here. Let's see, hopefully I can, okay. So before we get to the 2021 results from last year, I just wanted to reemphasize that our land values is based on some actual market sales data provided from the Farm Credit Association of Oklahoma. We're very indebted for their help in this study, and very thankful that they're available to provide that sales data. The average farmland sale last year was about $503,000, about $500,000. It's not exactly chump change. It comes from about 1,700 sales tracks, up from about 1,100 in 2020. And of course, if you remember back in 2020, it was sort of a lackluster market. There was a lot of uncertainty when it came to COVID. And I don't think that really the land markets and the overall economy really started to pick up until later on in 2020, and then enthusiasm returned. But certainly there was some enthusiasm in 2021. And so just judging by the number of sales tracks, you can see that it was a rather robust type of market. I did raise the sales ceiling from 6,000, which had been there since about 2008, all the way up to 9,000. I raised it by about $3,000, and this is still meeting the sort of the criteria of these parcels staying in production agriculture, and the income received is predominantly from production agriculture. The motivation behind the sale, behind the buyer, and also the highest and best use is still in production agriculture. Now, there may be some recreational interest, okay, but it's not the primary motivator, and it's not the primary source of income on this tract. If that buyer's motivation was strictly recreational interest, then I excluded from consideration in the study. Also, those buyers that were purchasing for, say, residential development or commercial development, even though it's currently in production agriculture. But if that's the motivation, I also excluded those from the study. And so you can sort of see the assumptions that I've made in terms of what I left in and what I did exclude. But once again, there were more and more sales that met that criteria in excess of $6,000. So also, we're not necessarily the only source of information on the block when it comes to land values. USDA NAS, they just released a report late last week on some land values, not only in Oklahoma, but nationwide. And also the Federal Reserve Bank of Kansas City, they release a quarterly ag survey based on some surveys conducted around their district, of which Oklahoma, of course, is one state, and it's all survey based. And so they ask their respondents as to their perspectives and their observations as to the surrounding land markets where they might reside or where they do business at. But I really feel like those additional sources of information provides a better picture, I think, of the or an overall picture of what's going on in the markets. And it does provide some comparisons and contrasts with our numbers. You would expect that the numbers to be different because our assumptions and our methodology is different, but the overall dynamics are really quite similar. So, but it does really, I think, paint a pretty good picture in exploring those dynamics of the land markets and what the drivers are. So let's get into the farmland values for Oklahoma, and you can see here that when you go from 2020 to 2021, it just shot off like a rocket. It was a rather heated market last year. It's kind of a sizzler, very reminiscent of the temperatures this summer. We had some stellar increases in these appreciation rates of about 26% for all land, across the board. Pasture a little bit less, cropland a little bit more. For all land and pasture, we hadn't seen performance like this for over 20 years. It's been quite a while. And so, it just doesn't happen very often. But I think that most of us sort of anticipated that this would be a distinct possibility, I guess, that we would have this much appreciation going on in the land markets around the state. Is sort of reminiscent of the housing market that we saw last year. I mean, I think all of us either read, or if you were an active, buyer or seller in the residential markets last year, you knew how that operated. It was crazy. And cropland, it hasn't been 20 years. Actually, it's you go back to about 2008, back to the ethanol boom. Before we saw, rates of appreciation very similar to this. But, in 2020, we just didn't see the performance in terms of, earnings and net incomes across the board in comparison to even 19. Of course, 2020 was a COVID year. So those numbers were actually down from 2019. And so I think that, impacted the values from 2 years ago. And even on the cropland, you can see that the cropland values have sort of trended down, and I'll get into that in a couple moments, what's been going on with that. But, since then, I think the overall earnings and then the impacts on, net cash or net farm incomes in 2021, if I was a betting man, I would probably bet the farm that those overall numbers were better than 2020, basically across the board. So anyway, I think that that greatly impacted the land markets, as well as a number of other factors. And I think a number of these participants anticipated better incomes in times ahead. I think there was a renewed sense of optimism in the land markets in 2021. Now, you may also wonder, okay, so you changed the rules of the game. You raised the ceiling up to 9,000. How did that really impact the numbers, as opposed to if you had raised the bar in 2020 and 2021? If I had raised the bar in 2020, a year ago or 2 years ago, The overall numbers would have been a little bit less, would have been diminished by about 2 percentage points. Not a lot, but just goes to show that we would have started from a higher, undoubtedly a higher average in 2020 had I, put a higher ceiling in 2020. And then the question begs, well, what if you had just left both of them at 6,000, 2020 and 2021? And stayed with the status quo. Well, in 2021, the all land would have been about 22% instead of 26%. And I think the pasture and cropland would have been about 2 or 3 percentage points, once again, lower than what they actually show. Still a very robust market. So it didn't really change the overall patterns in the markets that really it impacted to a certain extent the magnitude of the appreciation, but the overall trend was still very strong. And so when you look at the regional averages, more of the same. You look at the Panhandle, sort of a independent player out there, an exception to the rule, maybe an outlier. Now, sometimes the Panhandle does conform with other areas of the state just because averages, but when you factor only about 29 data points, that represents about 5,700 square miles of territory in the Panhandle. It just doesn't take too many tracks in any given year to influence that average. And so in 2021, truth be told, we had fewer, I think, cropland tracks which to analyze. And so we had more pastureland tracks or more, mixed utilization tracks, which tended to drive that average down a little bit. But I think that, if I had a chance to sample more tracks in that transfer market, let alone all of them, I think that those numbers would have been trending towards the positive end also. But I guess the big takeaway from this particular screen is that just because the regionals might have been stronger, the statewide average was stronger, doesn't necessarily mean that the track that you own also changed in the same fashion. I think that, in those particular locales that your track might be at, it really depends on the quality and quantity of that land, local supply and demand factors, and a whole multitude of other factors that are influencing those markets. And so if you're really wondering as to how that particular tract is performing or has performed, I would encourage you to consult and contact a certified ag appraiser or a professional farm management firm to give you a better feel for what that fair market value might be, or at least how that particular tract may have performed in the last year or two. All right. So then when we look at the cropland values by region, I really utilize and rely on 3-year weighted averages to sort of smooth those patterns and trends over the years. And just to remind you that 3-year weighted average is sort of a statistical method that, well, you weigh in, basically, it's all weighted over 3 years. And so you have 3 years worth of annual averages weighed depending on the number of sales tracks in any given year. So that 2020 number that you see at the very tail end of this chart represents 2019, 20, and 21 averages. And so when you factor in the 21 averages, then we see a kind of an uptick in those values. Of course, the Panhandle's doing its own thing. But anyway, you do see some strength in the market starting to return, especially in the north central region of the state, where we actually did see some declines in those values over the years since about 2015. Okay. So then when we move on to the pasture land values by region of the state, using that same procedure, you see a lot of sideways motions in the western parts of the state, which are indicated in red. A lot of livelihood tracks here where, the buyers or the owners of these tracks, their principal sources of income is coming from production agriculture. as opposed to the central and eastern parts of the state that are closer to your urban areas, as well as, of course, they're valued higher because of higher productivity, higher rainfall rates, and higher stocking rates, and so on and so forth. But we have a lot of smaller tracts also in the eastern, I would say 2/3 of the state, that are more reminiscent of lifestyle tracts, not livelihood, but lifestyle, where they are deriving some income from these tracts from production agriculture, but it may not be their principal source of or principal source of income. They are receiving most of their income from either away from that tract or from off farm in general. But that tract is still in production agriculture, so it's included in the data set. But once again, we have a number of these smaller tracts that are present in the eastern, I would say, portions of the state. And of course, there's still a lot of strength in those markets really going forward. And I expect that strength probably to continue, just because of some of that urban influences going forward also. So, the land markets, where are we headed to from here? Well, it's you could say that's a $64,000 question. Actually, it's more of a $500,000 type of question, reminiscent of that average, probably just due to inflation. And it's really a balancing act between several factors that are players in the markets. And of course, you have to look at earnings, whether it's not only current, where we're at, at the present time. And of course, the commodity markets are major drivers in what those earnings are, and what they are anticipated to be or expected to be down the road. But also, when you look at interest rates, and interest rates really do play a role in just how much can we afford to pay if we're debt financing. They influence the purchasing power. And of course, with these low interest rates that we have experienced over the last couple of years, it also, made a lot of financing decisions a lot easier. I mean, I wouldn't say it was a free money, but it was almost the next thing to free money in comparison to what we paid in the past. And especially, it also influences a number of interested buyers out there that could be, non-farm or off-farm investors that are thinking about, well, instead of investing in a fixed income instrument such as a 10-year treasury note that's offering a very marginal rate of return, it's risk-free, but they're receiving a really low rate of return. Do I instead, pour some money into the real estate markets, possibly as a hedge against inflation, but just as importantly, even though it's a little riskier in terms of, those earnings, at least those expectations are higher to begin with. So I'm willing to take that risk. And so interest rates do influence the attractiveness of those alternative investments. And of course, all of these really come into play for that demand for land. There's other motivations, of course, the motivations for a hedge against inflation, possibly, and just a pride in ownership. Those types of motivation factors. But we're going to look at it from a standpoint of more of an income producing standpoint, because I treat, farmland real estate principally as an income producing asset. And, I'm willing to pay for that farm ground, really depending on what I anticipate to pay, as a financing charge, which is the interest rates. And then also what influences my decision are those expectations for earnings down the road. And of course, commodity prices play a role in that. And so let's talk about commodity prices. And so, earnings are influenced by those commodity prices. So we, to get a perspective of, those crop farms around the state, I threw up a wheat price chart. It's sort of a proxy for the cropland or crop growing regions around the state. And, since the latter half of, the last decade, we saw a lot of sub $5 wheat. And quite frankly, the crop prices then, at least in comparison to now, were rather kind of dismal, not really stellar. And I think there were a lot of anticipations or expectations that those prices may continue, and so I think that carried forward into the cropland markets in terms of the enthusiasm. Okay, for bidding higher for these parcels that contain crop ground. But I think some of that enthusiasm started to change, especially in late 2020 and especially into 2021 when we saw a big rebound in these commodity markets. And of course, indicated by that blue line, even though you see 640 there for that 2021, 22 marketing year. Reason that it's only 640 is because it is a weighted average. And so those marketings are based on a lot of sales on the front end of the year. So there were a lot of sales sold across the scale last harvest season in 2021. Not a whole lot of wheat to sell at $11. There were some, and I'm sure there were a number of producers that wish they had, stored it and held it. But hey, they got a lot higher or a better wheat price than what they've had in the past. And so I think we had a lot of happy campers out there. But I guess the big question is that, going into the next marketing year or even beyond that, the concerns are, with a high inflationary environment that we're in, which is squeezing a lot of operating margins, can we bank on $7 wheat? That orange line there that was sort of indicative of that average in the first half of last decade. Are we going to see more of that? To me, that seems to be the new, I guess, floor or a break-even level. In other words, I think there's a number of wheat producers out there that are thinking, I've got to have at least $7 wheat out there in order to make this pencil out. In order to make my operating margins, even though they're tight, at least to pencil out, and to be able to pay for my bills. And let alone if they're thinking about, investing in some cropland down the road, they are probably thinking, I certainly hope it's $7 wheat or higher, that I can bank on and base my expectations are, in the future. And if that's the case, I think there will be some continued strength in these cropland markets going forward. If we're going to go back to, say, $5 wheat for whatever rhyme reason, that's sort of a worst case scenario now, but hey, anything's possible. And so if we go back to that in a high inflationary period, of course, I don't think that's going to be possible in a high inflationary period. But, if we go back down, well below $7, for instance, I think that's going to put a lot of pressure on these markets going forward. I think that there's going to be some hesitant potential buyers out there to just stand by the sidelines and say, hey, somebody else can buy that parcel. I can't afford it. All right. So I think that's going to weigh on the markets going forward. So a lot of this really depends on, if these prices are sort of the new norm. And if they are, I think that's going to provide some strength in these cropland markets ahead. Now let's shift gears a little bit and look at the pasture land side. And of course, a major player in the pasture land markets is based on, the beef cattle industry and how well it's performing. And the beef cattle industry is represented by those cow-calf producers and how well they're doing. This is sort of a composite, really nationwide of, provided by the LMIC of those cow-calf returns. Now we've seen some pretty slim returns or even negative returns in 19 and 20 and even in 21 by the behalf of the average cow-calf producer, however you want to classify that. And I think in Oklahoma, we can probably paint the same kind of picture. Some people have done very well, despite, some of these poor cattle prices that we see in the past. Point, though, to take away from this slide is, are they going to be around, going forward with their same cattle numbers, in their herd, or will they, be around and survive at a much smaller scale just because of the drought concerns that we're seeing? Yeah, the perspectives of higher beef prices are distinctly in the cards, going forward, but we may have fewer calves to sell at that point in time. So we'll just have to wait and see how this drought really plays a role, and also how that impacts your cow-calf costs. Now, our cow-calf cost in Oklahoma may not be $1,000 per mama cow, unit, but if we're feeding a lot of high-priced hay just to maintain our herd, or at least to mitigate the effects from drought, it just won't take very long before we get into some pretty high, feeding costs, and that will ratchet up our the overall cow-calf costs. And so it'll come at a price. It'll come at a price of either we want to maintain our herds, or it'll come at a price of selling or calling even deeper than we traditionally do in terms of percentages. And so drought is just not a good thing to have. It does always tend to rain after a drought. That's what my dad used to say, and that's true. A good rain would take care of a lot of problems, and that's also true. And so hopefully, that we can turn the corner and get some rains in this neck of the woods in the southern Great Plains, and improve the forage prospects, and reduce the pressures to feed some of this high-priced hay. But we'll just have to wait and see how this plays out. But I think a lot of this, uncertainty when it comes to drought is playing a factor on these pasture land markets going forward. And it's going to create some headwinds and pressures on those markets. Everything else equal, you just can't ignore that. So one thing that has played to the favor, of our purchasing decisions when it comes to a major asset like land, is we've had a low interest rate environment, which has really played to our advantage. Once again, it's made our financial decisions a little easier to pencil out, especially if we're debt financing. And then also we had just more of a demand in real estate, because the alternatives of these fixed income instruments were just less. And so they were willing to divert their attention towards real estate. But of course, we've seen some increases in these interest rates in the last couple months or couple quarters now, in order to combat inflation. And I guess that's the real concern right now, is how high will these interest rates go? It really depends on, how bad inflation stays. If it starts to tail off and trend back down, I think the pressures to increase these rates as much as what we see in the past would be less. But if we stay at these high inflationary levels, I think the ability of the feds to mitigate that is that the only way they can do that is to keep on raising those rates at major, increments of 0.5% or 0.5 point, 0.75 point, by major leaps and bounds. And before you know it, we're back to some operating note interest rates, or back to some farm real estate interest rates, or mortgage rates that we just haven't seen in years. And it's starting to have an impact on, I guess, the housing market. It's still pretty warm, in terms of its fundamentals, but it's starting to slow down a little bit. It's starting to kind of take a breather and reassess, on the parts of these buyers and sellers, maybe what's going on, and so they're not quite as active and quite as I would say aggressive in their pricing or bidding in those markets as what they were, and certainly in 2021. I think that's going to carry over into the ag real estate markets too, everything else equal. So I think one way to keep yourself kind of grounded when it comes to, how much can we afford to pay for some of this farmland, is really has to do with some capitalized values. And what do I mean by that? Well, Essentially, what we do is we treat farmland as, once again, an income producing asset. And so we're trying to come up with sort of a present value of a way to value a income stream going into the future. And so one way to do that is to look at those expected revenues, which is the numerator, and then divide that by capitalization rate. What is the capitalization rate? Well, it's an interest rate that's really converts those earnings into a value. And what does that really represent? Well, it's really it's the time value of money. Okay, and so if you're thinking of a low interest rate environment like what we've been in, a low interest rate environment like in 2021, when you look at that 10-year treasury note, it was only about 1.5% on average in 2021. And so, you look at your passbook savings, you look at CDs, it was all very low, last year in 2020. And so it was sure, guaranteed income, but at a very, low rate. So if you were to divide, say, a $45, say, rental amount, and this could be representative of, a landlord in North Central Oklahoma is receiving $45 from their cropland, and they think that, well, it's a good place to start. We don't know, what that rental might be 5 years, 10 years, 20 years down the road, but it's a good place to start. And so if we just shoot at a number of say $45 and divide that by 1.5%, that's about $3,100 per acre. In other words, if you were to invest $3,100 at a 1.5% rate of return, our earnings would be $45 per year. But of course, math is very sensitive on that fraction and what we can afford to pay. And so if we anticipate an environment where the interest rates are starting to go up, which is what we've experienced so far in 2022, then looking at sort of that interest rate of 2.5%, which is that 10-year treasury rate average so far in 2022, at least for June, you can see how that impacts that starting point and that value of $1,800 per acre. So once again, if you were to invest only $1,800 at 2.5% money, it generates that same $45 return. Now you can see very quickly, once again, this is sort of reminiscent of how interest rates impact those land values or any income producing asset. It makes it harder to finance, and it decreases the purchasing power. Okay, so we can only afford to pay less. And then also there'll be a number of potential bidders that we've had in the past probably shy away from ag real estate and devote their interests elsewhere in income producing instruments that are offering higher interest rates than what we've seen in the past. So at a cap rate of about 2.5%, you can see here, how that's impacting those cropland values going forward. And I would contend to say that, in 2021, we saw about $2,500 in cropland values in North Central Oklahoma. I think that the markets there and a number of active players in the markets, especially those active farmers and producers, are banking on at least $7 wheat at higher interest rates in order to justify that $2,500 per acre. If they're thinking about higher earnings, which also mean higher land values that they can afford to pay for, then those land values could go up, okay, or at least the strength is certainly there. But if we're back into an environment of lower wheat prices of say $5 or $6 wheat, then I think that's going to heavily weigh on the markets at these higher interest rates. Okay, so this is sort of what we're experiencing right now. Higher earnings do translate into higher asset values, but the opposite is also true. And of course, I think the major headwinds, or the sort of the counterbalance to this, is that higher interest rates, or the higher uh, cost of money, also influences those purchasing decisions as we go forward. And that, I think that's what the Fed is really banking on. They're increasing those credit charges. They're increasing really the cost of doing business. And I think that's going to, pressure the demand and lessen the demand for some of these goods and services that we're seeing in the economy, of which, these real estate markets are a part of. And so if we see continued increases in those interest rates at, say, $7 wheat, or choose whatever dollar wheat you have in mind, that's going to weigh on those markets going forward. Okay. So I wanted to also briefly compare how our numbers compare to USDA's. They're very similar, but obviously they're not identical. I drew a sort of a trend line through our numbers with OSU, a little bit higher, I guess, across the board consistently. But I guess the big takeaway from this chart was that, at least from the USDA standpoint, they did see a continued strength in the markets going into mid-2022 from 2021. Okay. And so I think that's giving, or at least providing, some evidence that the markets, at least here in Oklahoma, still have some legs underneath. The bull is still running with the herd, but maybe it's not running quite as fast as what it was in the past. And so we'll just have to wait and see how our numbers do compare with USDA's a year from now. But I do anticipate, of course, lower rates of appreciation than what I saw in 2021. And also the same thing when it comes to the pasture land values. I think that the continuing evidence is still there that we do see some inertia, some continued strength in these markets from 2021. And I anticipate some of that to continue into the remainder of 2022. But like I said, we do have some headwinds that we might be facing. And then, going into the study, I really thought that, well, I'd be very surprised if we didn't see at least double-digit increases close to 20%. So you look at this particular table for Oklahoma, it was close to 16 to 20% across the board. And sure enough, we matched that, if not exceeded that, in many cases. So in summary, when I look at 2021, it was just a stellar performance. You just don't see these numbers shake out like this every year. And I think the commodity prices and its impact on earnings, and those expectations to continue, it's really driving the markets right now. And but also low interest rates and the lack of alternative investments were also some positive factors that influence the markets. For the remainder of 2022, I'd say it's still higher in the short term, mostly due to some upwards momentum, or inertia, as we may call it, from 2021. I think that there's still some steam in the market, but it may take a breather, just depending on how these factors do shake out. And really longer term, once again, it's a balancing act between anticipated earnings, which really depend on those commodity prices, those interest rate levels, which look at this point in time to be going up, the financial health of the current buyers, and of course those potential headwinds of navigating from inflation. One sense of the word, it's pinching and squeezing those operating margins. And so I think you have a number of potential buyers there that are very cautious when it comes to being players in the real estate markets. But inflation by itself also does encourage some of these investors to invest in farmland. They're wondering, well, do I keep investing in farmland just because I think it's, those values will keep appreciating, or do I go ahead and start moving my monies into other interests that generate maybe a comparable return at a lot less risk. We'll just have to wait and see how that shakes out, as well as, of course, the drought concerns and how that will, play in the markets going forward. It definitely is applying some pressure on the markets just because we just don't know as to its length or severity. Are we at the front end? Are we already at maybe at the end game of it? We just don't know where we're at in terms of how this drought will play out. So there's a lot of uncertainty, like I said, once again, when it comes to that and how it will impact those markets going forward. So with that, we do have the website updated for 2021. But not only that, it goes back to about 50 years. It goes back to 1971. So you have a wealth of data to which to look at in terms of tabular forms and also in charts, which to look at overall trends and patterns over the years and some of the factors behind that. But also, I'd like to reemphasize that we have other sources of information for land values, and I think that really gives that decision maker a better perspective of the markets. When you look at it from the standpoint of the KC Fed or from the USDA, and then our numbers and our study, we're offering different perspectives of the markets, but we're offering it from maybe 50 feet versus maybe 500 feet or from different vantage points. But I think overall, by and large, we're seeing the same thing. We're seeing, the same trends and patterns over the years. And I think that it gives a decision maker at least that opportunity to make some good, sound business decisions down the road with these sources in mind. So with that, I'm going to turn it over to Brent. I really appreciate the opportunity to visit with you this afternoon on this particular topic. I'll be around for the next couple of minutes if necessary to answer any questions, but short of that, we do have a webinar survey available for you to follow up with. Let us know how we're doing with these webinars, and so we can hopefully make a good product even better for you, and make your decision to tune in that much more productive. If you have questions or any comments down the road, my contact information is there at the bottom. But short of that, thanks again for tuning in, and have a good rest of the day. I'll turn it back over to Brent.
Thank you, Roger. And I did share a link to that webinar survey in the chat box. If you have any questions now, feel free to ask them through the chat box, or you can also unmute yourself to ask them to Roger. I wanted to tell everyone that we do have another webinar scheduled on September 6th at noon. Farm management specialist Dr. Courtney Burr will discuss direct consumer marketing on that day.
Like I said, a good rain will solve a lot of these problems out there in production agriculture. I had, I was fortunate to have some rain over the house last night. Yesterday evening, it wasn't very large. It's pretty reminiscent of these local showers that we're having right now around the state. As my dad used to say, well, it rains on the unjust as well as the just. Well, I guess it rained on me last night, so it should be your turn next, right? So hopefully you'll get some rain soon.
Roger, it looks like we did get a question from Richard Coit. He asked, what was the percentage of borrowed money to purchase land?
That's a good question, Richard. I don't know. I'm sure that it's probably a sizable chunk of change, but I can certainly follow up with you later on. If you could send me that question to my email address, and I'll get back with you and I'll follow up on that. I think the KC Fed may have some information on that, but I'm not really familiar with that, but I'll follow up on it.
Well, I don't see any other questions. So I think I'm going to end the webinar for today. So thank you for everyone for joining us, and we will see you on September 6th.
Thanks again. Have a good day.